So, hello, and a massive hello to everybody. How's everybody doing? Hope everybody's having a great day wherever you are, whatever you may be doing. This is 50 Pips rocking and rolling here, 8th of November 2020. No trade calls, recommendations, or responsive loan stuff here for educational purpose only. So, we're going into this week. On Monday, this week we've got a lot of central bank speakers. So, we've got Lagarde speaking. On Monday, we've got Bailey speaking on Monday, too. Then on Tuesday, we've got, a lot of medium importance data with the ZEW out of Europe and a lot of FOMC speakers. On Wednesday, we've got an RBNZ decision with a bunch of bank holidays, so thin liquidity for Veterans Day. On Thursday, we've got GDP out of the UK, we got CPIs out of the US with the usual jobs number. We're going to have Lagarde speaking again, Bailey speaking again, and Powell speaking too. Then on Friday, we've got all the PPIs out, University of Michigan, and we got Bailey speaking again. So we could see some wheeling and dealing because of all those things on the calendar, but really it's going to be about, the election, how these things go. Well, on paper, President-elect Biden, Trump is probably not going to let things slide, so we'll have to keep in mind that things could be a little bit funky. I mean, in this situation, what I would say I would always recommend is focus on the levels as your core tenant, but then keep in mind what the kind of what the black swan risk, if you want, is, right? So meaning that all things being equal, markets are bid, a lot of uncertainty has been taken out of the markets, and everybody's sighing a sigh of relief. A lot of hedges taken off because everybody thought the market could tank on election night. And so now the markets are back into the usual climbing the wall of worry. Everything's good. We're going to grind higher. We're going into a seasonal period that's good. All good. So just climb, bid into the end of the year, Santa rally, etc., etc., etc. Now, what are the things that could be a little bit unsettling for the market? Well, right now, market's saying, okay, good, Trump's out of the way, but we still have a split Senate or Republican Senate, so basically nothing's going to get done. That's good for stocks historically. Now, once we get towards basically December and then also in January, if it's clear that it's going to be a blue Senate too, then the market may start to worry a lot more with more spending, more fiscal, more basically a targeted regulation of tech names. So you might even see that rotation out of tech and into small caps and traditional value pick up. But that's far way down, or at least that risk won't be off the table until December, January. Then the other thing could be if Trump keeps on filing all these lawsuits and then it seems that indeed he may have a case, then the market and there's social upheaval. The country's pretty much split. So that could cause a lot of but that's not for here. It's going to take weeks for that to play out. So short term, markets bid, everything's good. Just focus on the levels. I think that the focus is on how do you think the market is going to trade shorter term, because long term, with the way these things are going, you'd have to expect stocks higher, more stimulus, dollar lower. That's an environment which slowly those stocks are going to be grind higher. There'll be winners and losers. There'll be rotations, but stocks continue to grind higher. That's the situation where gold continues to grind higher, commodities continue to grind higher, and the dollar continues to grind lower. The question is, do you expect that move to happen in a straight line or not? And if you don't expect that to happen in a straight line, then you would expect equities to pull back a little bit here. You would expect commodities to pull back a little bit. You would expect the dollar to catch a little bit of a bid shorter term, right? And that's the question you have to ask yourself. Understanding that, surprise, surprise, we're still in the broader ranges. So let me draw this up starting left. You see how equities, we really haven't gone anywhere, right? You see how the high and the low is still in. Dow, the high and the low is still in. NASDAQ, the high and the low is still in. Gold, similar. Silver, similar. Crude, similar. Euro, similar. Cable, pretty much similar. Kiwi, similar. Aussie, similar. So is everybody, Swissy, bottom right, similar. CAD, similar. So is everybody scratching their heads like uber bullish, uber bearish? Really, both sides can still have a valid case because we haven't broken out of these ranges yet, right? So I think you have to be very, very patient and let these things play out. So as usual, if anybody's very interested in some longer term view, sure, I can go into it, right, email in. If not, let's look at some of these things slowly in terms of a short-term picture, or at least outlook for this week. Now, keep in mind that if we're going, some people asked about seasonality. If you're going into here, essentially, these are the trading days in November. We've basically gone through about 5 trading days. So here, normally what you would expect to see if you focus on these things is basically the market to trade down somewhere until the 15th trading day, and then to get the traditional rally into Thanksgiving and the Thanksgiving weekend. Through that's where it's been. So if anything, this middle period we're entering now calls for a little bit of weakness. I would like to focus on the SPY chart to start off with I think is the most interesting chart, and look at the daily, right? So in terms of the bigger picture, a lot of people are still going to be talking about this this megaphone pattern, and that the world is going to crumble, and that ES is going to be coming all the way back down into the 2000s. I think that's not in the cards right here. We can't talk about that. But what we can talk about is how we're behaving at these highs and how the market is trying to stall right at this level after having put in essentially 1, 2, 3, 4 gap ups. You can see that on the 15-minute chart. Essentially, no risk, all the gains are coming. You see we're gapping up as the overnight news are better for Biden, and the market is just going higher. So we know from past analysis and how we talk and while we go through these things, that these kind of moves, these are not strong moves. The market tends to give back these moves in a fraction of the time it takes to make them. That doesn't mean that it's the end of the world, but sometime there's going to be a little bit of a hiccup, and all those gaps, or the majority of those caps, are going to get filled very, very quickly. So this is not a nice structure to be buying the highs, getting bid. Here, the way we look at it, the risk reward is clearly to the downside. What does that mean? Is that if this continues to rally, essentially we're about 2%, 3% from all-time highs. And if you look at all those gap fills, those are basically about 6-7% away, okay? So if you're a betting man or a betting woman and you don't expect price to go from A to B in a straight line, a short here, right, with about 2% risk, there's an extremely good chance that if we get any kind of headline or any downside Momo, you'll get, 1 to 3, 1 to 4 kind of trade set up, right? Especially if you get daily closes back below this trend line. So what I'm trying to say is that there's a lot less resistance or support to the downside than there is resistance to the upside as everything's being priced in. And you always have the risk that this ramp meets some kind of the buy the rumor, sell the news kind of environment. So my base case is still that even though we may get a ramp to take out these highs or to take out these highs, and that's about, let's say, 2 to 3% down, I think the next, say, 5 to 6%, quick 5 to 6% move is to the downside and not to the upside. And that's what I will be looking at, and that's what I will be focusing on, okay? If you look at that on the ES, what does that mean? And this is, we've been talking about this on Twitter, is essentially intraday, any 15-minute, 1 hour, 4 hour, daily failure at the 3,500 offers extremely interesting opportunities to get short with a very, very tight stop to play even for a move back down into the 50 DMA or lower. It doesn't have to fill all those gaps, But if you can get shorts here set up with something like, a 2 to 5 or even 10-point stops around the 3,500 on ES, targeting the 3,400, right? You're looking at a very nice location where you're seeing, 1 to 10 plus risk reward setup. So clearly you don't want to stay stubbornly short as long as we're trading above the 3,500. But when we lose it, that's interesting. And it's the same discussion we had and the kind of trades we looked at in the weekly webinars, where we highlighted how here, even if the lazy trade short 12,000 NASDAQ stop above these highs, you're risking 4%. On any kind of move back into the 50, into the 100, into the 200, you're looking at 4%, 8%, 17%. This is what shows you that the risk reward is stacked to the downside. Again, you do not want to hold stubbornly short like where it is now, as long as price is hovering above the 12,000. But I can't stress enough, this is extremely interesting location. The moment we lose, if we lose 3,500, 12,000, not to stay stubbornly short when we're above them, but if we lose them, the conditions, the location is ideal to structure very high risk reward trades, either for a swing on the SPY or something like that, or short tactically on ES or NASDAQ when you're looking at 1 to 10 plus risk reward. I hope this is clear. If you're looking at the bonds, again, nothing much has been going on the bonds. You see they're still stuck. A lot of wheeling and dealing, a lot of pain caused intraday, but simply still stuck because nothing really has changed. Stocks are still bid. Fed's still there. They're going to do more stimulus. So really, the rates aren't going anywhere, if not down. So there's no reason for the bonds to have really moved. Gold, similar to equities, right? Equities, you had that 10% correction on equities. You had the recent bounce on equities. It's the same thing. It's trading in lockstep with equities. So there's not a lot to say or do here. If it can hold this breakout, then strong. This is much nicer than the equities, but any kind of move here, you'll just continue to see dip buyers. I'd much rather buy some kind of a flash crashy event on equities where gold gets taken back down to 1,800 or something like that. But again, this may be the base that is forming to continue to trade higher. And unless you get a big move on the dollars, there's little reason to expect this to really come down strong. If you're looking at crude is still trading very heavy. They tried to stick save it, but it's still trading heavy. No change in outlook for me. I think I would expect this to trade sub 30s before it takes out those highs in the 44s, right? But there's, again, similar to the bonds, kind of sideways chop here, not an awful lot going on. And DXY, this is an extremely important point, but you can see this is the reverse of equities, right? If the equities go through all-time highs, well, then you'd expect the dollar to take out these lows and then get very, very ugly to the downside. The only thing attracting it is going to be the 88, 87 mark. And if the equities can get a little bit of a correction, right, you'd expect this to bounce a little bit. But ultimately, I still think this whole 94 to 96 is solid resistance, and any kind of bounce that should still hold for ultimately the dollar to continue to trade lower and take out the 2018 lows, either end of this year, next year. It's hard enough without having to put a date on it, but that's the path of least resistance. And for the people asking me about Bitcoin, again, Bitcoin, everything is trading together, right? Bitcoin is trading with equities. You'll see if equities get smashed, gold will get smashed. Bitcoin is just a dollar trade. So it's again, we've always been of the opinion that hold for higher, right? Long-term hold. It's working out nicely. You have to be a little bit careful here because there's bound to be some kind of a double-digit puke, but they're a buyer. At this point, I think any move, even if this were to move, you'll find a lot of people wanting to buy this whole 10,000, 9,000, 8,000, any kind of puke, there'll be a lot of buyers coming in here. So going into the week, in terms of some of the Forex names in a similar fashion, yen, what's happening on yen? Again, here, as we've been saying, we expect this to come sooner or later and take this out and try to take a stab at the 100. But the more we get daily closes below the 104, especially the 103, you expect the BOJ to be very vocal overnight, talking about yen strength and not wanting yen strength. If we get into the 100, there'll be some proper intervention. But I think unless it gets into the 100, it's just going to be verbal, and that will continue to play out. Euro, not an awful lot is going on the euro. It's still fairly stuck. And again, no big change. 117 holding to the downside, 120 to the upside. I expect any kind of move into the 120. You'll get the BOE, the ECB talking about the fact that they don't want the euro at 120. Below 103, you'll get the BOJ on the wires talking about yen strength. Euro into the 120, above the 120, you'll get the ECB like they did before, talking about euro strength and not wanting the euro strength to come in, right? If you get USD CHF strengthen any more this week as you had last week, you're going to get SMB on the wire. The SMB actually is probably just going to start intervening a lot more. So I think what's also interesting in this context is that both Swissy and Swissy, Euro, yen, a lot of these currencies are at levels where the central banks are known to verbally intervene already, and that is highlighted by the importance of this location, as you can see on the DXY. So if you're picking for a place for the DXY, either to fake out to the downside and bounce or just to outright bounce, this is an interesting place. Look at USD CAD, similar kind of location. USD CAD, this is an area that's been holding since 2018 again, right? So this is a really interesting, because if they break down here, it gets very, very ugly, very, very quick. And that might coincide with equities trying to take out those highs, but it just doesn't really look like a place where it could really get traction across the board. Remember, we've got the RBNZ coming in this week. Look at where Kiwi is. None of these banks want a strong currency, right? And look at where the Kiwi is. So key level, this might set up a beautiful fake out above and then a nice short. Look at where the Aussie is trading. Similar. So we're really at an extreme point where if the dollar loses, you can get a melt up across the board, right, on these currencies and on equities. But I don't think at this stage it's justified or it could be sustained, because there's so much risk with Trump. And don't forget that until Trump leaves, nothing's going to be done. So he's still not going to do anything for COVID. He's probably going to want to sanction everybody. He's probably going to want to cause as much pain. You never know. Maybe he wants to tank the market so he can see the market tank because Biden won. I don't know. But all these moves that are on the verge of breaking out are factoring in or imply that Trump is just gone away and only good things and nothing's going to derail anything from now on. So I would be a little bit careful with that. Guys, hope this was useful, a little bit longer than usual. Write in if you want me to cover anything in the next video. All the best. Talk to you guys soon. Take care. Bye-bye, guys.